All right, let's talk about a hidden trap in retirement: state taxes on your Social Security. Now, you might think you're in the clear. And yeah, 41 states have gotten rid of this tax. But we're going to zero in on the 9 that are still hanging on. And believe me, they've set up some pretty surprising and costly traps for retirees.
So here's our game plan. We'll run down the list of these 9 states. Then we'll talk about this crazy thing called the tax cliff. We'll look at a few variations on the theme, see which states are starting to change their tunes, and, most importantly, I'll give you some solid ways to sidestep these traps.
Okay, first things first, let's name the problem. For all sorts of reasons. Maybe they need the revenue. Maybe it's just old laws on the books. A handful of states are still taxing Social Security. And what that creates is this really confusing mess of rules for anyone trying to plan their retirement.
As of 2025, it's down to just 9 states. 9. Now that might not sound like a lot, but if you live in one of them, this isn't some small detail. It can take a serious bite out of your retirement income.
And there they are. Now, what makes this so darn tricky is that there's no single rule book. Every single one of these states does it differently. Different exemptions, different income limits. It's a real minefield.
You know, we should also give a quick shout out to Kansas. They were on this list not too long ago, but for the 2025 tax year, they're pretty much out of the game for most people. It kind of shows you the way the wind is blowing nationally on this, which we'll get back to that later.
Okay, this is the big one, the tax cliff. This is the core danger we're talking about today. It's not some gentle, gradual tax increase. No. This is an all-or-nothing trap where earning just $1 extra can literally cost you thousands. So let's walk right up to the edge, shall we? We're going to look at the most extreme examples first, what we call the hard cliffs. This is where the penalty for earning just a little bit too much money is, well, immediate and really unforgiving.
Let's start with Rhode Island. If you're a single filer at full retirement age and your adjusted gross income, your AGI, is at or below this number, you pay exactly 0 state tax on your Social Security. Pretty straightforward, right? What could go wrong?
Well, what if you sell some stock and realize a small capital gain? Or maybe you just need to pull a tiny bit of extra cash out of an IRA. Let's say it's just $200, a small amount that ever so slightly nudges your income over that line.
And boom, there's the trap. That tiny little gain makes you lose the entire exemption. Gone. Suddenly, all your Social Security is getting hit with state tax. The result? A tax bill of over $1,000. Think about that for a second. That's an effective tax rate of more than 600% on that little $200 of extra income. It's just wild.
And hey, Rhode Island's not the only one. Down in New Mexico, the state's own legislative analysts have pointed this out in their tax code. They literally call it a cliff effect.
And the situation there is just as brutal. For a married couple, if your AGI is $150,000, you're good. But if you earn one single dollar more, that's it. The whole state exemption on your Social Security income just vanishes. It's the perfect definition of a tax trap.
Okay, so not every state on our list is quite that harsh. Some of them use different systems that can still be pretty costly if you're not paying attention.
So it's really important to know the difference between a hard cliff, which is that on-off switch we just saw, and a steep slope. With a steep slope, the pain doesn't hit all at once, but man, it ramps up super fast over a really narrow range of income.
Now, Colorado has this really interesting twist. I call it the age cliff. If you're 65 or older, you're golden, totally exempt. But for folks who retire early, say between 55 and 64, watch out. There's an income cliff. Cross that AGI line and you lose a huge deduction. It's a tax bill that can literally disappear the day you turn 65.
Vermont and Minnesota, they are textbook examples of these steep slopes. In Vermont, your entire exemption can disappear inside a tiny $10,000 window of income. And in Minnesota, your tax break gets cut by 10% for every $4,000 you earn over their limit. So it's not that $1 cliff, but it's a serious drag on any extra money you bring in.
And then you've got Connecticut. They actually used to have a cliff, but they fixed it. Now they have what you could call a safety net. Even if you go over their pretty high income limits, the state says, okay, we're only going to tax a maximum of 25% of your benefits. It really softens the landing.
And that's the good news here, really. The overall trend across the country is for states to get off this train and reform these kinds of taxes. West Virginia is the poster child for this. They are on the final lap. For the 2025 tax year, they're already exempting 65% of benefits. By 2026, poof, the tax is completely gone.
And Utah's system is just
well, a lot nicer than the others. They don't use a deduction that vanishes. Instead, they give you a tax credit that shrinks really slowly as your income goes up. It's more of a shallow slope, which is way less dangerous than the cliffs in Rhode Island or New Mexico.
Okay, so this is what you've been waiting for. How do you actually avoid stepping on these landmines? Let's talk about some real, actionable strategies.
These 3 strategies are all about one thing: being smart about when you take your income. You need to understand how different money moves can trigger these very specific state rules. You got to be proactive here, not reactive.
And let's just hammer this home one more time. That key term, adjusted gross income, or AGI, it's the magic number. It's what almost all of these states use to see if you fall off the cliff, and it's calculated before you take your big deductions. You have to know this number.
Okay, and this is a big one, so listen up. You might have heard about the new federal deduction for seniors. And yeah, it's great for your federal tax bill. But, and this is a huge but, it does absolutely nothing to help you with these state tax cliffs. Why? Because the states are looking at your AGI before that federal deduction even gets touched. So please, please do not get lulled into a false sense of security here.
When you boil it all down, it's clear that smart, proactive tax planning is absolutely essential in retirement, especially if you live in one of these 9 states. The rules are tricky, and the penalties can be really severe. So I'll leave you with this question. Are you just planning for this year's taxes, or are you building a tax-smart plan that's ready for the next 10, 20, or even 30 years?